G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann, and welcome back for part 2 of our market update, end of year market wrap with outlook ahead for 2022. I'm so lucky to be joined by Tim Lawless, head researcher and founder of the research division at CoreLogic. This guy, household name in the industry, and we're really going to get stuck into things in part 2 here. So we're going to continue to deep dive into, this time, the rental market, how it flows back around to affect the sale market. We'll do some comparisons with the other capitals. Going to go deeper into, firstly, how did the banks fare with their predictions for this year and what they've predicted for the coming years. And then we're going to look at our outlook and what investors should be thinking about going into 2022. So let's go inside.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth Property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management specialists servicing the whole of Perth. Now, here is your host, Jared Mann.
So the banks always come out with their predictions every year, and some investors would place a lot of importance on their predictions. I haven't seen the banks be that right ever. You can't say that, but I probably can. They predicted that Perth would actually have the highest growth of all the capitals this year, with ANZ, for instance, putting Perth at 12% and Melbourne at 7.8%. So how do you kind of reconcile how things have differed so much from what the majority of the banks predicted at the start of the year?
Yeah, CoreLogic doesn't have a formal forecasting model, but our index tends to be the base for each of the mainstream economic houses to forecast the market. So just looking at the forecasts from a year ago, they were made at a time of just extreme uncertainty for starters. So I think economists will generally base their forecasts on not just what they think is going to be happening in the housing market, but probably even more importantly is what's going to be happening in the economy and the demographic trends and so forth, which became much, these sort of things are always hard to forecast, but they became incredibly difficult.
Especially when we throw variables like what is ongoing lockdowns going to do to supply. And it almost seems like in hindsight, the limited availability in Melbourne, Sydney, and Brisbane to a lesser extent has actually really stimulated or forced their prices up. And that's just my layman view from the outside. But one of the wild cards, it's very difficult to predict how that might come into play.
Yeah, so I think it's going to be a moving feast, and you'll probably notice that these forecasts will be probably more frequently revised as well. We've certainly seen that through the second half of this year, to the extent now where we're starting to see each of the major bank forecasts are being released now to say 2022 or in some cases 2023. And just looking at those forecasts now, we've got looking at Westpac, they're forecasting
8%, isn't it? For
Perth 8% in 2022.
That was the better one for us.
Yeah, that's pretty much on par with the Australian average.
Yeah.
NAB was up 3.9% for 2022. You've got ANZ was forecasting a
3%, wasn't it?
Growth rate. That's right, and then you've got CBA with a 3% growth rate as well. And most forecasts are leaning towards negatives in 2023, factoring in the fact that interest rates will more than likely be higher by that time as well.
Yeah, and I guess when you see the media, at least here, I think it's almost because of our sentiment. They just grab the negative that's on the other end of 2023 and run that with their headline, Perth prices to fall, and they grab the highest negative that the banks have predicted, 9% by CBA was predicted, and they run with that. But it's always hard. There's a lot of noise for investors, isn't there?
Yeah, and to be honest, trying to predict where prices are going to be 2 years from now is not impossible, even at the best of times, and we're far from certainty at the moment. So, my advice to anybody trying to figure out where the market's going is look at the short-term trends, and the longer-term trends are going to be impossible to predict. But if you buy well, if you buy into areas,
buy a quality asset that
Yeah,
doesn't have those negatives that are going to show up more in a downward market. People will pay silly money for just to get into the market now and accept that you're next to a big power line or next to a, directly opposite a shopping centre. But when the market cools, I've seen just how much those factors can impact things. So I'd be cautioning people to stick to your ideal criteria, and we've got a whole episode on that previously.
Yeah, and stick to a budget as well. I think everyone would appreciate that interest rates will rise eventually. We're actually seeing fixed term rates rising now, but the timing of any rate hike from the RBA is still highly uncertain. Could be late 22. Financial markets are factoring in about 4 rate hikes next year, which the RBA is obviously hosed down, but the RBA is still sticking to a late 2023, maybe 2024 rate hike, which is looking increasingly unlikely now that we're seeing some inflationary pressures coming through.
I guess while we're on the hosing down of things, we've obviously seen APRA change their lending criteria. What other factors are you thinking from, I guess, a market indications point of view that might come into them changing or applying more brakes? And what are some of the things that you would perceive would go into that?
Yeah, well, APRA has been really, I think, clear. They released their framework for macroprudential policy in early November, I think 11th of November, which really sets out the key things that they're looking at. And interestingly enough, for the first time that I can remember, we actually saw APRA stating that they'll be watching asset prices very closely. But along with asset prices being mostly house prices or housing prices, they'll also be watching lending standards. So one of the key, I guess, metrics that stood out and probably prompted the latest policy change, which was the 50 basis point lift in the serviceability buffers, was the fact that high debt-to-income ratio lending was becoming much more common. So the latest data is only to June, unfortunately. We'll see an update through early December for the September quarter. But in June, we saw about 22% of home loans were being written with a debt-to-income ratio of at least 6 times. And that was getting really high. That was virtually the highest on the short time series that the APRA publishes. But it means that households are taking on higher debt levels at a time when we know household debt levels are already quite inflated, especially for housing-related debt. So that's probably the key.
That's certainly going to be the case when you look at even the median house price of Sydney and Melbourne. It's pretty scary for us and our sense of value here when we see just how much they've grown and how high they are. So, God, I struggle to think how a family can even get into a good school zone or without pushing the budget now.
Well, the median house price in Sydney is $1.3 million. In Perth, it's $550,000. So just quite a remarkable difference. If you remember, back in 2006, Perth was actually a little bit more expensive than Sydney, funnily enough. And now
for a long time where we were the second most expensive in the country.
Yeah.
And so you can only, while we can't predict immigration and interstate migration, you'd have to think that value plays a big part in it. That's my feeling anyway.
Absolutely. And affordability is central to that. And Perth's gone from being the most expensive capital city to the most affordable. There's no other capital city. Even Hobart, Adelaide, Darwin have a higher median value.
It's crazy. That was the lowest median. We've been forgotten, Tim.
Well, I wouldn't say it's been forgotten, but it's gone from being overvalued, I think, fairly enough in 2006 to being significantly undervalued at the moment. So you'd have to think there's some pretty decent upside.
I guess that's why I feel like even if we get some headwinds and the brakes put on because of, I guess, policy being driven by what's happening in the other capitals, then I still feel like coming off of this period, fundamentally, we're going to be in, very good stead. And if it does slow down, I think it may only be for the shorter term, and we won't have a big drop like we've had off of the back of our other boom, because we haven't, when you look at a 16% gain and factor that in over the last 5 years or even 10 years, what our net gain is, we're still, I think we've still got a lot of upside, and whether that comes I think we're not going to have as big a weight to move around into a growth phase again. It might just mean we need to wait for things to cycle through over east and have liquidity open up again and have a few other green lights for us.
Yeah, over 5 years, Perth housing values are up 1.6% per annum. So a little bit less than wages growth over the same time, which is quite unique for any capital city. Darwin's the other example where that's been the case as well. But affordability is certainly nowhere near as challenging as what it is in most of the other capital cities.
So let's touch a bit on the rental market, and we'll then get a few other comparisons on the other capitals before we wrap. And I know your time's very precious, and you've got your big release coming out tomorrow that you probably need to prepare for. So what have you seen on the rental market and its performance this year?
Yeah, rents have been extraordinary across Perth. Perth and Darwin have really stood out as being just exceptionally strong rental markets. It looks like things might have just started to level off.
That's what I was saying. We've sort of sat. Rewa has its median price, and I track a number of other data providers and stuff, and I know median isn't everything, but I also know the median, and I watch the rents on our portfolio of 800 odd properties too, and we've often tracked very closely to the overall Perth market, and things seem to have just leveled a little bit at this 450 sort of price point. But then Rewa's data is showing that the vacancy rate has retightened again down to 0.9, and how that translates we'll see. But what I do know is that the number for rent on the market's incredibly tight still from their data point of view, and you can only see it holding. And I would expect rental prices will continue to increase, but again, it depends. I think once we get immigrants happening again, that's only going to bolster that increase. So what's your data showing? I just gave you my synopsis.
So we're seeing rents across Perth are up about 14% for both houses and units over the year to October. They did peak at about a 17% growth rate coming into the middle of this year, 17% annual growth rate. There's a few differences here. Perth houses and units are showing really similar conditions, whereas most other capital cities are showing much weaker rental conditions for the unit sector. Not so in Perth. I think that just really reflects the limited amount of unit supply that's flowed into that marketplace over time. And another, I think, just contextual point on how to explain why rents have been rising so quickly goes back to that conversation we we're having a bit earlier around investment activity. Between 2014 and 2017 or 2019,
good one.
We saw investment activity fall from about 40% of demand down to about 13% of demand. And of course, every market around the country is reliant, every rental market is reliant on private sector investors to introduce rental stock. So I think over the last decade or so, or at least the last 6 or 7 years, we've seen rental supply has really tightened across WA, particularly in Perth.
It was more the reluctant renter, if you will. So we've tried to sell our house and we can't get the price that we wanted. So they put it on the rental market, and a lot of those properties, as the prices come back and they're able to achieve what they wanted to, there are a lot of what is getting sold out there. So that is also not keeping stock rentals in the stock longer term. And, we're actually having I'm seeing a lot of pullback, and a lot of the agency owners I speak to are down on their rental portfolios for the year for that reason. So,
no surprise. And I think rental markets across Perth and regional WA will remain tight, especially once we start to see state borders opening up. I can only imagine this recent softening we've seen in the rental trends is simply due to the closed borders and probably a lack of interstate migration coming through.
Yeah.
So that you have to imagine that's going to bounce back from both interstate migration picking up as well as overseas when it finally when we see international borders opening up. So I think for rental conditions, investors' ears probably perking up here. You'd have to expect that rents are going to be a fairly strong component of the Perth market. And that's against the backdrop of yields that are already relatively high.
That's worth touching on, isn't it? I was shocked when I saw just how low the yields are in the other states now.
Yeah, well, Perth yields have been trending a little bit lower as well, but they're way above the national average. So typical house, these are gross yields, typical yield about 4.2% for a house, about 5.3% for a unit. So for most investors, if you're getting a fixed term mortgage rate that's probably the low 2% range, you can take about a percentage point off a gross yield to net it out, just a rule of thumb. You're probably looking at positive cash flow properties on average across the marketplace. So quite different from...
So that's going to insulate people from some of the interest rate increases that are to come whenever they do. And do you have any thoughts on or data? Because I've been trying to compile this myself, but it's really difficult to know. But obviously there's a lot of tenants that are rushed in to use the grants to build new homes. And I've kind of been waiting until we see the day that these tenants are going to be moving out into their homes. Any feel for how that, what sort of data we're looking at, or any way to gauge what sort of impact this might have?
Yeah, I think the numbers, the numbers of homes being built are quite extraordinary. We've seen 140% increase in house commencements across WA, and about a 37% increase in completions. That's over the June quarter compared with the June quarter in 2020. So
we were coming off of a very low base, though.
Off a low base, fair enough. It's definitely seeing a lot more supply coming into the marketplace, which I think is very welcome, right? You're always talking about more supply helps to improve affordability and so forth. But to your point, maybe that will take some of this pressure out of the rental market. It really depends on what happens with interstate and overseas migration. Adds more fuel to this rental demand.
Yeah. Where do we sit in balance between the two? And what's the timing for each? Because anecdotally, builders could be another 12 months away from the majority of properties underway actually getting finished, especially if the shortage of trades continue. So,
absolutely. Yeah, you'd have to expect more and more of these people building a home are going to see a bit of an extension in the build period. And if they didn't book in a fixed price contract, then potentially they'll be into a bit of a rude shock with construction costs going up so substantially as well.
So how is Perth, I guess, compared? We've touched on a few comparisons along the way, but how is it compared with the other growth rates in the other capitals? Because just good to give some context.
Yeah, so there are some extremes. If you look at just across the capital cities, you can look at markets like Hobart, Canberra. So Hobart values are up 28% in a year.
Wow.
A market that's generally been very strong over the past 5 years. Really benefited from a lot of mainlanders moving over there that seem to be quite cashed up. So a lot of capital coming in.
A change to the country and potential work from home, I guess, and just wanting to get out of lockdowns. And
a lot of mature age folk as well, looking for retirement options and flexible working arrangements. Canberra hasn't seen very much disruption through the lockdowns either, up until recently at least. Values there up 25%. Sydney's up 25%. Brisbane's up 22%. So in many ways, even with Perth's 16.4% growth rate over the year, which is a pretty significant increase in values, there are a lot of other capital cities where values have increased more. And then you get into some of the regional markets. Look at go to somewhere like Noosa or Byron Bay or
lovely places to visit.
Yeah, they've all seen values rise by more than 30%. Yeah. So some absolutely extreme results when you look around the country, and I think this shift towards, or this popularity of remote working and flexible working arrangements has really opened up a lot of those coastal and tree change regional markets for much higher demand.
Oh, excellent. So is there any other parting thoughts you can give us on what investors, I guess, should be mindful of with regard to Perth and maybe the overall property market moving into 2022?
Yeah, I think just to sum it up, clearly for investors, the biggest factor most investors look for is capital gain, and yields are often an afterthought for whatever reason. But if you look at the capital gains in WA, they've been pretty mild over the medium to long term, which doesn't necessarily mean they're going to be stronger going forward. But you'd have to argue that the Perth marketplace is undervalued at the moment. You can see that simply just in the relativity of median values compared to the other cities. You can save $800,000 buying in Perth rather than Sydney, just on averages. And then you've also got the yield is another really good way to benchmark fair value, at least against rental rates. And the yield in WA, particularly Perth at 4.4% gross, is much higher than most of the other capital cities. In fact, the only other capital that's higher is Darwin, which is a lot more fickle, a lot more volatile than what Perth is ever going to be.
And I've often seen that direct interplay between when yield is stronger, tenants want to get out and investors want to get in, and it just flows back around to price increases one way or another.
Yeah, that's right. And I think just that strong yield profile together with what's hopefully going to be some prospects for capital gains will be really attractive to investors, along with the relatively low entry price, which as we see serviceability conditions tightening across lenders and lenders becoming a little bit more cautious, that low buy-in price probably makes it a lot more achievable for a lot of investors to get into the market in Perth.
Yeah, it makes sense. And thank you so much for all your time and insights today. I'd love to have you back sometime next year, and hoping you have a wonderful Christmas ahead.
Great. Thanks, Jared, and all the best to you and your staff as well.
Thanks so much, Tim. Cheers, mate.
Cheers, mate. Ciao.